Wealth can be measured in many ways. As it grows, life can quickly become complex, creating the need for more focused planning. Welcome to We're Talking Money with OmniStar Financial Group. OmniStar has been helping clients achieve financial success for more than 20 years in a client-centric and stress-free environment. With a reputation built on a long track record of working with people who want to grow and protect their assets, OmniStar illuminates the blind spots and provides actionable strategies to help you achieve what's most important. This is where you can count on straightforward and unbiased advice from a team of professionals that are passionate about your success.
Hey, good afternoon, everyone. Welcome to We're Talking Money Live, coming to you from the Wilmington studio. I'm Phil Clark, and I'm going to be your host today. I'm with OmniStar Financial Group. Thank you so much for tuning in, and I sure hope you get a lot out of today's episode. We're going to be talking about something pretty important. We're only a few days away from tax filing deadline. That's the 15th. So here we are on the third day of the new month, and we are literally just days away. So we're going to talk about tax environments. There's 5 of them as we see it, and we're going to go through the 5 tax environments, what they are, how they work, and what you need to know to take advantage of them. A lot of people that we talk to, a lot of our clients, they don't take advantage of the benefits that are right in front of them, and that's because they're not properly, or they're not aware of those things, or no one has properly educated them on them. So I'm going to do my best to share some of what you might want to know or need to know as you get towards tax day. Now, some of these things you can't use for the upcoming tax filing deadline because we're past periods that would be considered a deadline for implementing some of these things. But some of them you can still use, so you want to be aware of those. And preparing for next year, so your 2021 year, preparation is essential to reducing your taxes. So let's get started. Again, we're going to talk about the 5 tax environments, and we'll go through each one from what I think is maybe the least complex, and then we'll go a little deeper into more complex things. But just because they're not complex, that doesn't mean that they're not important. For example, our first environment, we're going to talk about personal taxes. All right. So environment 1 is your personal side. It's your personal taxes. So what do we need to know about this environment? For starters, it is the least efficient of the 5. That's the first thing that you need to know. It's not efficient, and you'll see why in just a minute. So when we speak of the personal environment, think about earned income, basic needs, basic living, food, shelter. Those things would come under personal. Tax advantages in this environment, they're limited. Why is that? Well, all of your expenses here are after tax. So anything that you're spending money on in this environment, it's always going to be after tax. And so that makes it one of the most expensive tax environments of the 5. Now, when you think about the personal environment, basically it goes like this. All of your income defaults to the personal level. So unless you've made other plans or you have other arrangements to trap some of those dollars or to shield them from the personal level of taxation, they're all going to head to this environment called personal. When they do, you're going to pay tax on that. And so things that you can imagine that you already know are going to flow into this area would be things like your earned income. Tax deductibility flows or is part of this environment. Tax credits. Think about what's a good example? So child tax credits, for example. If you have children, you get a tax credit. Now, that's different than a tax deduction. We're going to talk about that in just a minute. So taxable income, taxes owed, all of those things at the personal level, you think about those in this personal environment. And so what do each one of those really mean, and how do you how do you mitigate tax inside this personal environment? Well, first of all, if you have earned income, the first thing you want to do is figure out what amount of that income can you shield from tax. And the first way to do that is look for ways to defer that income or to put it in other places. So things like a retirement plan, things like cafeteria plans at your employer. You can use those things to put some of those dollars away or into another area before they come to you where they're going to be taxed. So that would be the first thought. So check those things as you go through 2021. You can't change any of that for 2020, but you can certainly change it for 2021. So if you're not taking advantage of those things and you don't know what is advantageous or not, reach out to us and we're happy to help you with that. Tax deductions. Now, this one's very important as you're filing your taxes here. And even though you've only got a week or so to go, you can still talk to your CPA or your accountant about these tax deductions. Now, here's what you need to know. Standard or itemized. Most filers, gosh, probably 90% or better today don't file with itemization like they once did. And that's because the tax changes over the last few years took the standardized, the standard deduction that everybody gets, they took that to a much higher level. And so when that occurred, itemization became not a thing of the past, but certainly not as useful as it was. And that has really changed the way people file their taxes. Much simpler if you're not itemizing. And it's easier without a doubt. So if you're married filing jointly, you've got about $24,000-ish to use as your standard deduction. So if your itemized deductions don't go over that amount, then you can't itemize. So maybe you're wondering, well, which is better for me? Well, might not matter which is better for you. Might simply matter which one's going to reach that number, the limit on the standard deduction. You get the best of either number. So if your itemization or your itemized deductions go over that number, you can take the itemized. If they're below that number, you get the standard. So you get the bigger of the two numbers. Here's where a couple of key points need to be addressed. One, you can use a lot of things to reach this itemized status. Your state income tax, you can use that as part of your itemization, but it's capped at $10,000. So if your state income tax goes above that, you can't use it. But let's say that you have $10,000 and then you've got mortgage interest and then you've got maybe some charitable giving. You could easily go above the $24,000 number. And if you do, then itemization clearly is a better way to go. But if those things don't get you to that number, then don't worry about it. Just take the standard deduction. Now, taxable income, we talked about. Tax deductions, those are things that you can still consider now prior to your filing in the next week or so. And then taxes owed. So we just talked about that. You got a limit on the amount that you can use towards itemization that happened in 2020. So if you're not sure about those things, check with your CPA, check with your accounting team, and figure out if any of these things can benefit you as we get closer and closer to the deadline. And by the way, most of you already know this, the deadline was extended for a month this year. So we should have had this conversation several weeks ago, but instead of April 15th, they gave us an extra month. And you all know why. That's due to the COVID thing that we've all been dealing with now for the last year and a half. So let's leave environment 1, which is the personal side. Let's take a look at environment 2. And environment 2 is the corporate world and corporate tax. So all you business owners out there, listen up. This is very important. Anybody that might be considering a business, maybe you're thinking about buying a business, maybe you're going to start a business, you want to hear this part because it's going to make a huge difference in how you might consider establishing your business or what you do with your existing business. So with the right knowledge, this environment provides tremendous favorable tax treatment for excess income. Depending on the structure, and there's lots of them, we're going to talk about a few of them in just a minute, many advantages are gained through the exploitation of current tax law. So these are all things that you would say are legal, or maybe there's a loophole. But however you want to describe it, the fact of the matter is all of these things should be considered if you're a business owner or soon to be business owner, because they make a huge difference on your taxes and on the bottom line. So what do you need to know about corporate structure? First, entities. What are they? There's S Corp, there's C Corp, and there's LLCs. Those would be the basic three. Those are the ones that you've heard about. Now, there's partnerships, there's sole proprietorships. Those are not corporations. A partnership is certainly can be taxed as a corporation. So there's lots of entities, and there's a number of styles that people will use as it relates to setting up their business structure. But the three main ones, S Corp, C Corporation, and an LLC, limited liability company. So they can be used for lots and lots of corporate deduction. That's just the beginning, though. So don't think that that's all we're talking about here is just setting up a structure and getting some deductions. There's much more. So literally everything which comes into your corporate structure, that's business income. And literally everything that goes out is a business expense. And so depending on the nature of your business, the structure that you use, as well as your goals and objectives, risk mitigation strategies, those are right at home inside of these corporate structures. So now we're not talking about just tax, we're talking about risk mitigation. So liability, risks as you think of it from the business owner's perspective, those are real reasons why you'd want a corporate structure. But if for no other reason, taxes, that's a big one. So let's stay on the track of taxes. So depending on what you are trying to accomplish, you need to decide which business structure makes the most sense for you. So let's talk first about C Corporation. Why would you set up a C Corp? When would you set up a C Corp? This entity probably has gained a pretty bad reputation as it relates to tax, and I'm going to tell you why. But it has regained some popularity under the current tax law, so it's not nearly as bad as it used to be. It's not as good as necessarily as it could be. It can always be better. So C Corporation, the entity has regained some popularity under the current tax law. But you have to be careful here because C corporations are known for double taxation. And that's not something that can easily be avoided. In fact, it's almost impossible to avoid it. Why is that? Well, all of the income to a C corporation is going to be taxed at the corporate level. Now, in a C Corp, you can have retained earnings, but it's all going to be taxed as it comes in. And then it's going to be taxed as it goes out in the form of dividends to its shareholders. And anyone who collects income on a W-2, they're going to pay income tax. So taxed on the way in, taxed on the way out. And if we're strictly speaking of business owners, then they're going to be taxed on all the dividends that go out to them. So they're going to pay it at the corporate level when it comes in. They're going to pay it when it goes out. Selling that C corporation, that brings about another set of double taxation. So C Corp, when and why? Well, there are some reasons today why you could use a C Corp and use it very favorably. And so I would tell you, don't discount a C Corp. Don't ignore it, because depending on your situation, it could be a reasonable way for you to structure your business. That would be something that we would want to talk about at a much deeper level, because once you make that election, it's a little hard to undo it. let's talk about something that's more popular, which is the S corporation. Now, everybody's heard of that, but I want to put a little something on the table for you to consider about an S corp. A lot of folks say that they refer to that as a corporation, but an S corp is an election, not so much a structure. It is an election. You could have a regular corporation and have it taxed as an S corp. So it's a part of the IRS guidelines or part of the Internal Revenue Code, and it is a election. So, for example, you can have an LLC taxed as a subchapter S. So again, you make the election. So S corp, when and why? When would we have one of these and why? So first, it's an election, not a structure. Second, you want to think about an S corp when you are going to be taking income as an owner because it can reduce your self-employment tax. So if you're in a LLC and you've been watching your business grow, it's getting better, it's flourishing, then you might want to think about taxing it as an S corp. Now, you can't change that for 2020, but you can certainly make that election as you go forward. And the reason that's important is every dollar that comes into your LLC is a pass-through. It's going to flow right down to you at the personal level, and you're going to pay self-employment tax on 100% of the income. With an S corp, on the other hand, if you choose that election, you can reduce a lot of that self-employment tax. Very, very important because we're talking about a little over 15% tax on every dollar coming into that LLC that flows down to your personal tax return. Now, if you elect the S corp, basically what happens is you take a reasonable salary, and everything beyond that you can take as a distribution. And that distribution to the owner does not pay the self-employment tax. So you can avoid some of those excess taxes just by making an election. When would you make the election? Let's say, for example, what most people have are LLCs. When would you make the S election? There is a number of theories out there as to when you would do it, but I would say not so much a precise time on when you would do it. I would say it's more about your income. So the higher your income and the more your business is growing, if you've got several $100,000 a year of take home, if you will, or net out of that LLC, you absolutely should consider an S corp because you can reduce a lot of that taxation. So distribution to the owner, you absolutely want to think about the S. Now, the LLC, so popular, everybody does it. Why? Why is that? Why does everybody have an LLC? Well, they're easy, for one, super simple to set them up. They're pretty cost effective, but they're not always the best when it comes to taxation. They definitely give you some corporate feel, and they give you some protection as it relates to liability. So all of that's great, but they may not be the end all be all. You might want to consider an S corp election, even though you have the LLC. And again, watch your income. When you start taking, say, $100,000 a year out of that LLC, you probably want to consider an S corp election to help you reduce some of those self-employment taxes. Excuse me. So, in the corporate world, there's a lot of things you can do to reduce taxes. The corporate veil helps you from a lot of angles: liability, tax, and then the reduction of the self-employment tax, taking an LLC or a corporate structure and giving it subchapter S election, which means the taxes become flow through, if you will, much like the LLC, but you have the ability to tax some of it on your W-2, self-employment tax applies, and then the remainder would go to you as a distribution, no self-employment tax. Keep in mind, you can only have up to 100 members in that entity. So if you're going to go over that, S corp may not be the right fit. But worth considering. So don't forget that. If you're an LLC, don't forget that. Now, where an LLC makes sense and perhaps you don't need the S election is if you're simply using an LLC for liability protection. Maybe you've got some property that doesn't generate income, or maybe it's a small amount. If you want to own that property in something that gives you some planning for estate planning purposes, or gives you the ability, I should say, to do some pretty creative estate planning, or maybe you just simply want the liability protection, then owning real estate in that LLC, that could be a great way to use it without having to make the S election. Now, lots of thought around this. We can't cover all of it in one show, but just know that an LLC absolutely has a place. Very popular, and they do some really, really good things. S Corp, really, really popular. Not always used when it should be. I think that should be considered more often, and be nice for you to have your CPA or your wealth advisors or someone like OmniStar help you with that so you make the right decision. Let's move from environment 2 now. Let's head into environment 3. This is tax deferral. So tax deferral, what does it mean? Everybody says, well, what exactly is tax deferral? I hear that question every year, and I think a lot of people get confused about what tax deferral is. Tax deferral should never be confused with tax-free. You hear it talked about in life insurance. Folks will say, oh, yes, this is tax-free. What they mean in the cash value a lot of times is it's tax deferred. Now, some parts of it can be tax-free, but generally once you get past what you've paid in terms of premium, then everything else is potentially going to be taxed as ordinary income. So you have to be really, really careful when you hear someone talk about tax-free. Sometimes what they really mean is tax deferred. So we're going to talk right now, environment 3, we're going to talk tax deferral. So let's talk about what it means to defer tax. And again, we've already said it doesn't mean to eliminate tax. It is deferring taxes. That means we're going to pay for them or pay those taxes at some point, or someone's going to pay them. So when used properly, deferral is a great tool. So because it's not tax-free doesn't mean it's not good. It is a great environment. It's a great strategy when used properly. So deferred savings, without a doubt, they can improve your long-range wealth accumulation strategy. But you've got to know when to use them and how to use them. So when and how. The most common use of tax deferral, let's get everybody on the same page here. What's the most common form? Well, it's pretty much for everybody. It would be saving for retirement. So your 401k plan, that'd be considered a tax-deferred environment. You get to put money in before tax. So before it comes to you as taxable income, you get to put it in this vehicle, and it grows without tax. But it's going to be taxed when you begin to make withdrawals in retirement. Now, simplified employer pension plans, or SEPs, those are very popular, tax deferred. Defined benefit plans, also known as a cash balance plan for some of you business owners. Under pension rules, that is, it's kind of a hybrid. It looks and feels a little bit like a 401k, but acts more like a pension plan in terms of how you fund it. Again, tax deferred. So it's going to be taxed when the money comes out, but money goes in before tax. So that would be classic tax deferral. Annuities. And this one, we've done some shows on annuities, and while they don't always have an appropriate use in everyone's situation, they are appropriate for some situations. So don't count them out. Annuities have quite a stigma, but it doesn't make them all bad. I really think, as we've talked about on other shows, the stigma really is more the people selling them, not the annuity contract. Annuities generally are a good tool, all about tax deferral. They're also a pretty good tool for income. That's what they were designed to do. So I don't want to make this an annuity show, but just keep in mind when you hear that word, don't all of a sudden have this grimace thinking that they're bad. Usually annuities that they've been stigmatized because they've been misrepresented and missold. Now, back on track with deferral or tax deferral. So one more thing that people think about or forget rather when it comes to tax deferral is real estate. And a lot of folks don't realize that investment in real estate can be deferred as it relates to the capital gain tax. And it's an interesting little environment. If you wanted to sell a property and move those monies into another property, you can use something in the IRC or Internal Revenue Code called Section 1031. And that allows you to sell a property, buy another one. Now, there's quite a few hoops that you jump through. They're not too difficult, but you've got to do certain things within a certain amount of time. And if you do those things, then you can carry on that or delay that capital gain tax bite. So another opportunity to use tax deferral there. So depending on the vehicles that you use, your money could be saved before or after tax. In an annuity, generally it's going to be after tax money going in, but still tax deferred now on the growth. With 401ks or SEPs, chances are that money's going in before tax. So when in a standard setup, if you will, or in a traditional kind of retirement plan, it's going to be taxed when it comes out, but when you put the money in, it's going to go in pre-tax. So huge advantage there. But again, don't forget, this is deferral, good thing, but you are going to pay tax on it. So what's the takeaway here? A lot is gained by deferring taxes, no question, particularly if you have a lot of years left in your career. So if your earning years are still pretty high, if you think you've got 10, 15 years to work, then a tax deferred environment can be a huge opportunity for you. Now, what happens to this money when you reach retirement? Pay attention here. This is very important. You're going to be taxed on this money when it starts coming out in retirement. What about if you're well into retirement? This is even more important today. And I want to speak to this for a minute because some of you are trying to plan for your retirement income or your retirement distributions coming from these accounts that have embedded tax in them. Well, there's a real problem with those accounts today because we've lost what was known as an IRA stretch provision. And for a while, we enjoyed this stretch tool or provision that said if you passed away and left your IRA to your children, they could stretch it over their lifetime, take required minimum distributions based on their mortality rate, and that would allow them to leave the monies in that tax deferred environment in some cases, 10, 20, 30 years, which really, really increases the opportunity for them to grow that money. That's been taken away. The most you can do today is 10 years. So if you leave an IRA or a 401k to your children, they've got to have it out of that environment within 10 years. And you can imagine they're going to pay a significant amount of tax. So if you've got $1 million IRA, you leave it, within 10 years, it's got to come out of that environment and be moved into ownership of the beneficiary. Well, they're going to pay full income tax on that. So if they're already making a couple $100,000 a year and you leave them, you leave them $1 million, they're going to pay the maximum taxes on that money. So better to have a plan for that. So if you're already in retirement, what can you do? Couple of things. One, you can use the distributions from those IRAs. You pay the tax on it now. Presumably, your tax rate is lower today now that you're not working. You can use those monies to fund other parts of your estate planning. The second thing you can do is don't worry about it. Just name that IRA to your favorite charities, or you can use a charitable remainder trust, which would allow you, or rather your family members, to take income from that money for, say, 20 years. Now getting effectively that stretch provision again. And then when their 20 years expires, the remainder goes to a charity. all of the income tax embedded in that huge IRA is completely removed. You don't have to worry about that. So if you are getting close to retirement, if you're in retirement, or maybe you're really late in the game and you're trying to figure out how do we reduce or eliminate or at least strategize a little bit in terms of getting those taxes to be less onerous, if you will, there are some ways to do that. So let's think about that before you just ignore it. Think about it. And if you don't have anyone giving you advice on those things, reach out to us. We're happy to help. Lots of information here. Very, very controversial subject in some ways, but in my opinion, just simply one that doesn't get talked about enough. So a lot of opportunities here. Generally speaking, let me just say this about tax-deferred accounts. They are going to be taxed on withdrawal. And with the exception of the 1031 that we talked about for real estate exchanges, the withdrawals are going to be taxed as ordinary income. That by itself, in my opinion, warrants some planning. So ordinary income, much bigger tax than, say, capital gain. The 1031 tax deferral method, that is always going to be taxed as capital gain. All right, so that takes us through the first three environments. What do you say we dive into environment 4? And we call this one tax advantaged, right? So what does that mean? Well, for many taxpayers, itemizing, it's still a useful strategy. We talked about that early in the show. In the first environment, personal, we talked about itemization and the standardized deduction today, which is somewhat removed itemization. I think the most recent study that I read seems like something around 90+% of our taxpayers in the U.S. don't itemize today, and it's because that standardized deduction is so much higher. But let's see if there is an opportunity here. So when we talk about tax advantaged, let's figure out exactly what we mean by that. So mortgage interest, for example, that would be a tax advantage. Charitable contributions, that's a tax advantage. Residential property taxes, but remember I said the maximum is $10,000. We'll say that again in a minute. All of these can have a significant effect on your taxable income or on your adjusted taxable income. So keep in mind, as I said, most people don't itemize, and it's not always because they don't have enough to reach beyond that threshold for the standard deduction, but a lot of people just don't think they can itemize anymore. They've heard that the standard deduction is all you can take, and so they fail to consider itemization. Recent law said that standard deduction would give most taxpayers an advantage, and frankly, I think it did. So every taxpayer can appreciate that, but it doesn't mean that you should not consider itemization. The standard deduction for married couples filing jointly, it's now $24,800. That's for 2020. So while you're getting ready to file your taxes here in the next week or so, keep in mind, if you have donations, you have state income tax, and other things that fall into that deductible category, you might want to double check whether itemization or the standardized deduction is the most sensible way for you to file. It could be that the most advantageous way is for you to itemize. So $24,800 is what you had for a standardized deduction in 2020. 2021, it went up just a little bit, $25,100 for the current year. Now, your state income tax, you can use that towards your itemization, but again, it's limited to $10,000. Don't forget that. Mortgage interest. Now, I want to talk about this one for a minute. Some of you in the last year have gotten on the crazy train as it relates to real estate. Man, has real estate just gone crazy in the last really year and a couple months now. You know, just before COVID kicked in, real estate was by and large healthy, but it wasn't rising at such a rapid pace. We didn't see all these transactions. Things were what I would say a little more normal. But after COVID, it seems like people just thought, well, gosh, if I can't go somewhere to spend money, I'll just go buy a house. And all of a sudden, this real estate boom was in high gear and seems to be continuing. I've spoken to a lot of realtors over the last several months, and 2020 was a record year for them. And many of them tell me that 2021 is much the same. So that's a good thing. But keep in mind, if you had a good 2020 or in the last several years, things were good and you decided to buy a higher priced home, you can only deduct your interest on that home mortgage to up to a $750,000 mortgage. If you go beyond that, so if you've got $1 million mortgage or $1.1 million or $2 million or whatever it is, anything over $750,000, that interest cannot be deducted. Only the amount up to a $750,000 mortgage can be used for your for purposes of itemization. Medical expenses. Now, this one everybody knows. It's been around forever. Didn't really change. Your medical expenses, for you to use them for itemization, they have to be at least 7.5% of your adjusted gross income. Now, I'm just going to tell all of you, and I'm going to say this with zero reservation here. You don't want this deduction. If you are taking medical expenses as an itemized deduction, you're probably not healthy. And for that, if you are, I just simply say to you that I hate that you're dealing with whatever that is. If you're healthy, don't wish for this itemized deduction because you're probably in a pretty bad spot from a health standpoint. Long-term care premiums, they must exceed 10% of your adjusted gross income. But if they do, you can deduct your long-term care premiums. That's a pretty big deduction, potentially. Charitable contributions, one thing I want to throw in here. Now, all of these are things that you can use for 2020. These are things that might very well be part of your tax return for 2020. And that deadline comes up here in just a week and a half. So keep in mind that these are some things that you could use. And so to determine, anyway, if you can use itemization, and if you can, by all means, please do. So long-term care premiums, we said, if it exceeds 10% of your adjusted gross income. A couple of new things that you need to be aware of. Charitable contributions. There is a $300 for everybody. Doesn't matter if you itemize, doesn't matter how you're choosing to file here, but $300 above the line for everyone. So that's more like a tax credit. That's literally like a dollar for dollar offset. Don't forget that one. Be sure that you ask your CPA about that. Most CPAs are going to remember that. They're going to put it on your return. But if not, just know that there's a $300 above the line deduction that everyone can take. Now, charitable contributions in general, they cannot exceed 60% of your adjusted gross income. So if you are trying to itemize, and I think you should absolutely look at this, a lot of people made significant charitable contributions in 2020. Obviously, due to COVID, a lot of charitable entities or charitable organizations, they were under a lot greater pressure than in a normal year. And so the asks were pretty big. A lot of charitable organizations were asking people to donate more than normal, and a lot of people did. So if you donated a lot last year, then one, kudos to you for doing so, because I know you helped a lot of people. But if you didn't know it, be sure that you look at that for itemization purposes, but also you need to know that it cannot exceed 60% of your adjusted gross income. Now, investment interest expenses, you can use that. So any investments that you've dipped into or poured some money into, you can use that interest as part of your itemization. And then up to $2,500 of student loan interest. And that's above the line, by the way. So another really powerful tax deduction there. All of those things can go towards itemization. Don't take it for granted that you only get the standardized deduction. Look at these things, carefully consider them, because you might be you might be missing a lot of tax savings that you didn't know you had. And so itemizing would be the only way for you to capture that. Be sure that you look at all of those numbers. If you're not sure, check with your CPA, check with your accounting team, whoever does that work for you. Or if you want a second opinion, feel free to reach out to our firm. We're more than happy to help you do that. As we come into our last environment, what I want to say to everybody is, no matter what your situation, tax planning is a tremendous opportunity, but it's also detrimental to your long-term wealth strategy if you're not doing it. If you're just taking for granted that your CPA is doing everything right, or that surely you're not in a position to take advantage of some of these things, don't be credulous enough to believe that none of these things are available to you. A lot of these things are available to a lot of people, but you've got to do your part and verify that, or at least be willing to ask the questions of those who you trust to prepare your taxes. And if you're not sure, reach out to a firm like ours, or whoever it is that you work with, and get a second opinion on these things. It's not that difficult. It just requires a little question and answering session, really understanding what you're trying to accomplish. And if those things are properly described to the right people, then those folks can absolutely tell you if standardized deductions make more sense, if an S Corp is a good idea, is it an LLC maybe that's better for you, should you itemize? All of those things should be answered. Let's talk about our last environment. I saved the best for last. This is not tax deferred. This is tax free. So what is that? And a lot of people will say, oh, there's no such thing as a free lunch. Well, for the most part, that would be correct. I would tell you that I most of the time agree with that. It's very, there's very few times in life where you'll find something that's free. Although you hear lots of commercials that tell you it's absolutely free, and then some people tell you that it's mostly free. But to me, free is either free or it's not. There should be no qualification there. But here is what falls into environment number 5, and that is tax-free. So this environment, it's often missed because it's misunderstood, yet it provides a lot of options for additional tax savings. So depending on your situation, everything depends, there's no question, but depending on your situation, things such as municipal bonds or municipal investments, 529 plans. You've heard of those for college savings, preparing for higher education, maybe for your children or grandchildren. Tax-free benefits built into those programs. Health savings accounts. This one gets missed all the time. If you are self-employed, or if you are employed but have a high deductible health care plan, a health savings account is, in the colloquial way of saying things, it's a no-brainer. If you have a high deductible plan, or if you're self-employed and you have a high deductible plan, you should absolutely do an HSA. And the reason for that is an HSA does a couple of things. One, money goes in before tax, kind of like an IRA. Money grows without tax. There's that tax deferral that we talked about, but in this case, it's tax-free if you're going to use it for medical expenses. So put the money in, you get a tax deduction. Grow the money, there's no tax. Take the money out for medical expense, tax-free. If you get to retirement and you've accumulated a lot of money in this HSA or this health savings account, guess what? It's not a use it or lose it program. You simply roll it to an IRA, and now it's part of your retirement bucket of money. Now, the taxation changes at that point. Instead of the money being tax-free coming out, you will pay ordinary income tax just like you would on distributions from your IRA or your 401k, but you enjoyed tax deferral to that point. And if you were using it for medical expenses, tax-free distributions, and everything going in was pre-tax or tax deductible. Tremendous opportunity. You can put thousands of dollars in these things per year. I believe in 2020, with your makeup provision, you could do $8,100. If you're not over 50 years old, $7,100 would have been your limit. Watch that every year and make sure you're funding it. Now, keep in mind, you must have a high deductible health plan, but if you do, don't miss that opportunity. Another great way to save before tax, accumulate tax-free, and worst case, accumulate tax deferred, and keep the money for retirement, whatever amounts left. Best of all, depending on where you open your health savings account, you can invest. It used to be that these were only held in cash or money markets, something of that nature. But today, for example, all of our health savings accounts are held at Fidelity. Obviously, they're our custodian on the wealth management side. So all of our accounts are through Fidelity. Well, we can invest those monies any way you want. We can use mutual funds, individual stocks, you name it. So huge advantage for opportunities to grow that money. And then Roth IRAs. Let's talk about this one because it gets missed a lot, and it really should not be missed. It's a tremendous opportunity. Roth IRAs can provide long-term tax reduction. It can be tax-free on distribution. Roth IRAs, though, get missed because people think, well, I make too much, I can't put money into a Roth. Or they think, well, I probably shouldn't do a Roth. I like to save tax right now, so I want to get the tax deduction. So I'm going to use traditional IRA or traditional 401k. Well, what you really need to do is work with your tax preparation team or your tax consultant or your wealth advisory firm and figure out which one really makes a lot of sense. Sometimes it's both. Other times it's absolutely the Roth. And depending on your age, your stage of life, your goals and objectives, it could be traditional saving. It could be 401k or traditional 401k or traditional IRAs. So don't just decide that because of what you've heard or read that Roth doesn't make sense for you. Even when you make too much money to get a Roth in the traditional sense, you can do something called a backdoor Roth, which means we can fund an IRA and then we can turn around immediately following that transaction and transfer the money to the Roth IRA. No penalties whatsoever. And everyone has that opportunity. Inside your 401k, if your 401k is set up properly, there are the limits in your 401k plan are much higher than a IRA. And believe it or not, you can do a backdoor to a Roth IRA in a 401k. In fact, you can just use Roth 401ks on your 401k chassis if your employer allows it. And you can put a lot of money in that Roth with no limit, or rather with no testing. So you can do that just like you could a normal contribution. Or if you want to do more than the normal contribution under Section 415, you can put a lot more up, in some cases up to 60,000 or more. You can actually do a backdoor in that 401k, and we call it a mega backdoor. So instead of IRA contribution limits, now all of a sudden we would have 401k or Section 415 limits, much, much larger as far as limits are concerned. And you could literally get the bulk of that into a Roth. Why is that so important? When that money gets into the Roth, yes, it's after tax in terms of money going in. But once that money's in, tax-free on the growth, tax-free on the distribution, no minimum required distribution at age 72. And when you leave that money to your heirs, so when you move on to your next world and it's left to your children or your family members, zero tax. Tremendous planning opportunity with a Roth. So I hope that today's show has given you some insight as it relates to taxation, particularly the 5 environments. Every kind of tax falls into one of these environments. I would encourage you to know them, learn more about them. If you're not sure about some of what we talked about, feel free to reach out. You can reach us via email at omnistarfinancial.com on our website. You can call us. Our local number in the Wilmington office is 910-319-7834. Plenty of ways to reach us. You can find us on Facebook and LinkedIn, so all kinds of social media channels. And we hope that you'll reach out if you have questions. Happy to share this information with you. If it'll help you plan better, we're more than happy to share it with any of our listeners. So that's going to wrap us up for the 5 tax environments. I hope you've learned a lot. It's been fun sharing this information with you. I look forward to seeing you on our next show. Until then, take care. Have a great day. Bye-bye.
Thanks for joining us on We're Talking Money. Be sure to visit us at omnistarfinancial.com, where you can learn more about how we provide value to our clients. Subscribe to the show and our newsletters, and drop us a line with topic suggestions for upcoming shows. If you enjoyed the show, we would appreciate you passing it on to a friend and providing a rating on iTunes. This podcast is a publication of OmniStar Financial Group. The content is developed from sources believed to be reliable and accurate with all information. The information in this material is not intended as tax or legal advice and may not be used for the purpose of avoiding any federal tax penalties. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions expressed and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security or service provided by OmniStar. All expressions of opinion reflect that of the authors and are subject to change. Any distribution, use, or copying of this podcast, other than the intended recipients, is prohibited.